Morning, everybody. Welcome to another episode of Student Loan Talk. I'm your host, Joshua Cohen, the student loan lawyer, and today is April 22nd, 2020. We are now in our fourth week of the pandemic, I believe. So a lot of things have happened. We've had the CARES Act come through, which is protecting many, but not all, federal student loans. We have, and actually what I want to talk about this week a little bit is what states are doing to help those other people left behind. And last week I also talked about Joe Biden offered a student loan forgiveness plan on his platform. And also looks like the Department of Education, specifically Betsy DeVos, has a settlement to process the borrower defense to repayments in the next 18 months. And if not, there are some significant benefits for those that they screw up with. So that's a quick recap of last week. A lot of what I've seen over the past week is states stepping up to protect borrowers not protected by the CARES Act. And again, the CARES Act protects people that have federal loans with the Department of Education. So that's any direct loan or an FFEL loan that has been in default for quite a while that was passed on to the Department of Education. If you have an FFEL loan in good standing, it's not protected. The best advice I'm hearing and saying is either apply for an income-based repayment if you're not already on it, ask for a recalculation to get it lowered, or simply consolidate your loans to direct loans right now, and then you'll be covered by the CARES Act, which again is 0% interest. It is no payments due, and if you're in collections, no collections as well. And so yes, Maria, as you point out very obviously, private loans aren't protected by anything, and that's why I want to talk about this week what some state governors and governments have been doing to assist. We've seen this in a lot of the larger states. Illinois did one, Mass, New York, California. They have come down with, shall we call them proclamations, amendments to their orders that private student loan companies, they are requesting that they give some kind of assistance. Now, one thing that the states do have control over is their state guarantee agency. So as an example, here in Vermont, Vermont Student Assistance offers both FFEL loans and private alternative loans, or Alpine loans, I believe they call them. And so one thing I'm seeing a lot of state agencies offer on their private loans is a 90-day forbearance. So that gets you through until July, and at least no payment is due. What I'm not seeing, which would really strengthen things, is if they would also forgive interest or just cut interest for the next 90 days. We're not seeing that yet. And my other question, I haven't seen an answer to this, is what are they doing about the term of the loan? Are they also stretching that out by an extra 90 days? Or do these 90 days count under your regular term, and therefore when you get out, your payment's gone up because now you've got 90 days of payments to spread out through the rest of the amortization, the rest of the term of the loan. That's not a huge deal, but it could be when you also consider that interest is still accumulating. And interest rates on private loans are all over the place. They can be from 3 all the way up to 15, 18%, which is ridiculous. Honestly, most private loan interest rates I've seen are between 5 and 12%. The other problem is you've got cosigners. So now those cosigners are being dragged into it. But again, on the good side, not only are they offering 90-day forbearances, they are also not reporting any negative credit reporting. So if you do take that 90-day forbearance, they're not reporting anything negative on your credit report. They'll continue to say you're in good standing. And the credit reporting is going to be very, very interesting at the end of all of this, because with the CARES Act, in addition, anybody who entered into a deferment program through their mortgage, their car financer, their credit cards, there's no negative credit reporting for the duration, which means I'm really curious how creditors are going to evaluate credit after this when they know that the credit may not actually be honest in the sense of were you in good payments or not. But everyone's going to be in the same boat. In fact, some people may have better credit than they deserve when we're all done with this. That's neither here nor there. Honestly, I am not a big proponent of credit and credit scores. If you're not aware, credit scores are nothing more than a marketing ploy, because the credit score that you get when you pull from the big three is not the same score that mortgage companies see or auto financiers see. So if you're not aware of that, that's a big deal. If you're paying for credit monitoring, it's not the score you should care about. It is what's reported. If what's reported is accurate, they have complied with the law, the Fair Credit Reporting Act. The Fair Credit Reporting Act only requires the, as we say, the maximum accuracy of what's reported. There's no obligation that debts be reported, but if they are, they must be accurate. Okay, so I got way off tangent there. I apologize. But again, states have been moving towards their state agencies offering private student loan protection through 90-day forbearances. Some of them are going a little longer. Some of the interest rates are doing better. Sorry, none of the interest rates are doing better. I wish they would. I see a question here which is relevant. Okay. I'll get to that question in a second, Maria. That's a very good question. So they're offering forbearance. They're not really doing anything about the interest rates. Again, if you have an FFEL loan, IBR is the way to go, income-based repayment. If your income has decreased or is it just bottomed out, if you're unemployed, you can apply either for income-based repayment or recalculation if you're on it, and your payment should be zero. And that's good for the next 12 months until it's time to recertify. If your recertification is in January, well, it'll carry you through until January. So the question, Maria, is do I suggest refinancing private loans? Especially now, I'm always nervous about refinancing them and not being eligible for any loan forgiveness. Okay, we need to take that apart because private loans don't have any forgiveness eligibility anyway. What I want to take apart are the semantics. When you say private loans, do you mean genuinely private loans, not federal loans, or do you mean FFEL commercial loans, as they're calling them now, that are still federal loans but not protected by the CARES Act? And I think that's what you're talking about. FFEL loans, as a refresher, are loans that were originated by anybody but the Department of Education. So you could have gone to VSAC like I did, or you went to Sallie Mae or Navient or a private bank like Chase, Wells Fargo, even a local credit union. And the promissory note plainly stated it was a Stafford loan or perhaps it was a PLUS loan. And again, you can verify if you have a federal loan by going to studentaid.gov. Log in. Any loan there is a federal loan. If it's not there, it's private. But the semantics that have come out is under the CARES Act, direct loans are covered or loans held by Department of Education. They're calling FFEL loans or any loan not held by Department of Ed that's federal a commercial loan. And I think that's a misnomer. It's still a federal loan. So going back to your question, Maria, if you have an FFEL loan, you have two choices. You have three choices. You can leave it where it is and apply for income-based repayment. You could consolidate it over to direct loans, in which case now it's covered by the CARES Act, no payments or interest until October. And you could apply for repay, which is cheaper than income-based repayment. Zero is zero. You're not going to get better than that. But it may mean the difference between a $10 and a $7 payment or a $200 versus a $150 payment down the line. So I like repay there. So choice number 2 is to do the direct consolidation. Choice number 3 is to refinance it with the private student loan lender, like SoFi, Citizens Bank, a lot of other banks will do it. I do not ever endorse taking a federal loan and turning it into a private loan, because that is where you are correct. You lose eligibility for any forgiveness because private loans don't offer forgiveness. If you have an FFEL loan and you're on income-based repayment, then yes, you will get the 25-year forgiveness. If you are a government or nonprofit employee, W-2, 30 hours or more a week, you're full-time, then you could qualify for public service loan forgiveness. And if that's the case, you must have a direct loan. FFEL loans don't qualify. So you want to bring it over to Department of Ed as a direct loan, and you want to then either stay on IBR or get into an even cheaper repay. So that's my suggestion there when you ask about the refinancing. Donna's got a question on repay. Can you only count borrower's income like IBR? The answer is yes. So on income-driven repayment, all of those income-driven repayments, which is IBR, ICR, repay, pay, and new IBR, because they ran out of acronyms, you can strip out your spouse's income, even if you file taxes jointly. Now, you have to read the application carefully, and it's under the marriage statuses. And you have to read it carefully, and if it applies to you, you can strip out your spouse's tax income by reading those boxes carefully. However, if you and your spouse both have federal loans, then there's no reason to. You'll get a household payment that will be split pro rata between you and your spouse. But for Donna's question, on repay, can you only count your borrower's income like income-based repayment? The answer is yes, you can. You must follow the form on how to do that. Good question, Donna. So, again, what's going on with the CARES Act is interesting. I won't be shy about saying it's a ploy. It's ridiculous that Congress had to step in because, honestly, Secretary DeVos could just snap her fingers and every federal loan would have an administrative forbearance that would stop all collections. It would stop all payments. The only thing that DeVos couldn't do is have a lower interest rate. That Congress had to step in for. So, yeah, it's nice that we stopped interest, but why aren't we protecting FFELs? And again, Secretary DeVos, if you're not sure how to do this, please call me. I'll help you through it. All you do is snap your fingers, and everybody in the area that has a declaration of emergency would be covered by it. And they've done this they did it in Hurricane Katrina. They did it for Hurricane Sandy. They did it with the California wildfires, some of which was under DeVos's direction. So she knows how to do this. She's simply choosing not to. Now, if you want a conspiracy theory, I won't go into that. But to me, it's a ploy for people to consolidate and bring their FFEL loans over to the Department of Education. This is an instant cash infusion for the FFEL market because when you consolidate, you're paying off your loan. That means the FFEL lender, whoever it is suddenly getting paid for your loan. And what a great way to bail them out during this time. Okay, Chris, do you think there will be anything for private loan relief, such as First Mark Services? Okay, so First Mark Services is a servicer. They don't own them. But yes, the question is, will there be private loan relief? And my response is there's only so much that they can do. Congress doesn't necessarily have firm jurisdiction over private loans. Thanks, Ron. Yes, Secretary DeVos probably has misplaced my telephone number. Do I think there's going to be more serious relief for private loans? I'm not really sure. Again, I'm not sure there's too much Congress can do. It's almost like, how much control do they have over car financiers? Yeah, they can talk about usury and interest rates, although that's usually controlled by the states, which is why you have vastly different usury laws and caps on interest rates, and why certain credit card companies are based in South Dakota, where usury rate is upwards of, 30% or so. I'm not sure. We can Google that later. So for private loan relief, honestly, I'm not sure. Private loans to me are a really big catch-22. They've got skyrocketed interest rates that you can't afford, which causes you to default, which ruins your credit, so you can't refinance to a better interest rate that you could afford. It's a nasty catch-22. It's almost like a whirlpool. Once you're in it, and you don't realize it until you're in it, and then you can't get out. I will say there are some outside of the box things that I've thought of as ways to do it. I love taking private loans into bankruptcy and getting them discharged or getting a really good settlement, but I don't really push for that because bankruptcy it's the big B word, and not everyone needs a bankruptcy, and I'm not here to push you into that. So, Chris, one advice I'd have for you and for everybody with the private loan is contact your lender and see what they're offering, because there is a public relations angle here. Every bank that I know with mortgages, and again with even credit cards and with auto finance, they're doing something. They're offering something. And I don't think private student loan lenders want to be left in the we're not doing anything. I don't want to think they want to be seen as inflexible. And so I think call the lender, see what they offer, and then you might want to call your local newspaper or news channel and say, hey, I've got a private student loan. I called the lender and they're not offering anything. Would you like to do a story on it? And most TV stations, even newspapers, have a consumer law watchdog, and they might be very interested in something like this. So, you as a borrower, you have the right to push some buttons and see where it goes. Honestly, it's not going to harm you because it's no worse than where you are. Maria, great question. Will I leave the video up? Yes, I always post all of my videos onto my Facebook page, and they will be there. They're also on my website at www.thestudentloanlawyer.com. All of my past videos are there, so you're welcome to review them. Welcome to leave comments and any questions you have. I would ask that if you do have questions, feel free to post them because that becomes material for the future conversations that we're having here. I'm doing these every Wednesday at 1:00 Eastern Standard Time. And I'm glad to see that they're popular. And really my goal here is to help you. I'm not soliciting for your business. I'm doing just fine. And I'm hoping that you don't become one of my clients. I'm hoping that we can keep you out of hot water, that you can handle it yourself. Years ago, the Consumer Financial Protection Bureau said no one should be paying for student loan assistance services. And they're correct. You really shouldn't have to pay for this. I mean, 90% of what I do is just translate so that people can do a face palm and go, oh, I should do this. And they're absolutely correct. Unfortunately, I exist because the industry can't seem to speak plain English. They can't seem to go off script. They respond to your question. And if your question isn't really what you're looking for, then the answer isn't going to be what you're looking for. Or if your question's really advanced, then the floor worker goes, I don't know, you're not in my script. Let me send you up the chain. And eventually you go in circles and circles. And it annoys me to no end that I will talk to somebody, for 30 minutes or so, figure out their issue and answer their question when they've been going round and round for years with the Department of Education and the Ombudsman and the CFPB and even their congressperson. And it's why my hair is so short, because I pull it out. It's astounding. It's not that hard to figure this stuff out if the industry would just sit down. And I love some of the testimonials that some of these lenders give that, oh, they helped me pay off my loan, yada, yada, yada. Well, that's because the loan never had a problem. I want to see a testimonial from someone that had a problem thanking the bank. They're not thanking the bank. And it's not hard to solve these problems. This industry should know the law better than I do, and they should know how to fix things. And they just can't seem to do it. That's why I exist. I exist to fill in the gap of what the industry can't seem to get right. I would be happy if I no longer did student loan work and I did bankruptcy work. I've always wanted to do bankruptcy work. I don't have time to do bankruptcy work because there's so much student loan work. For those of you that are attorneys out there, I invite you to ask me questions and get involved because there's plenty of work out there. Lenders are screwing up. I'm not going to say it's a conspiracy. I'm not going to say they're doing it on purpose, but I'm seeing negligent screw-ups that when you look back at the pattern, it's very easy to see, oops, they messed up here, and then here, and then here, and then here. And it shouldn't rise to a level of a lawsuit, but sometimes it does. And, look, you got to do what you got to do. I love lawsuits because they're public record. So that's when the lenders and the servicers and the collectors start squirming. So I got way off tangent there. I was talking about private loans. The point here is I want you, again, with private loans, contact your lender or your servicer directly, but also look at your state's page. A lot of states now have COVID-19 information pages. Your governors may come out with proclamations every so often. Look for those updates and see what they've got. Actually, I would encourage you to do that first before you call the bank so that when you call the bank, you can say, hey, my governor says that you guys have to offer X, Y, Z. And if they say, no, we don't, well, call the governor's office or your state's attorney general and then see what happens. You might become the poster child for the rest of the state. And Again, if you have a private loan through your state agency, call them and really ask good questions and dig into it, because again, I'm seeing that they're actually offering things that they're not publicizing. I was amazed. I had an exchange with VSAC just over a press release they released that I wasn't really all that impressed with, and so I sent them an email, not as the student loan lawyer, but as me, Josh Cohen, and after 2 or 3 exchanges, I fished out that they actually have some great programs. They actually allow private loan borrowers to get their loans out of default through a program. And I responded saying, why aren't you guys publicizing this? Why would you want people to be in default? Don't you want to get them out? And, I know I was dealing with a customer service person, and I said, I really hope that you do a press release on this, because this is magic. Nobody wants to be in default, but if you give them that hope and that rescue string that they can tie on and they can get their loan out of default, they're much more motivated. And I still haven't seen that press release. It's been 2 weeks. So I'm doing my part to let people know, hey, if you've got a VSAC private loan, there are ways to work with that. And I'm happy to work with anybody to discover new ways. I will also say, if you happen to be a lender or a servicer or connect with any of those, please let me know. I'm happy to put up those resources to let other people know that there are things that they can do. Or if you happen to know of resources, let me know. I'll start publishing them, and let's get this stuff out. I mean, the only way we're getting through this is together. I don't want to be a kumbaya type, but the bottom line is we're all resources for each other. There's so much information out there. You're going to get lost in it. It's a sea of uncertainty, and it's just insane. And so I'm going to stay focused on student loan stuff, but if you have other resources you'd like me to pass on about foreclosures or about bankruptcy or about mortgage, whatever it is, I'm happy to pass that on. And I have been encouraging other consumer attorneys I work with that perhaps they should start doing, similar Facebook Live events about what they do. I've got a former attorney I used to work for does only auto fraud, and I'd love to see him do something about auto financing and what you can do. All right, Cassandra's got a good question here. Is it true that when you rehabilitate a loan, most of the collection service fees are wiped away, compared to when you consolidate a loan, all the collection fees stay? A servicer told you this information, and the servicer lied, Cassandra. Let me tell you how it works. When you consolidate or rehabilitate and you're fully out of default, the collection fees go away. When you're in default, they're allowed to charge up to a 25% collection fee. So if you go into default at $100,000, you now owe $125,000 at most. When you get the loan out of default, that 25% collection fee goes away. The $25,000 is gone. It is replaced with something else. Now, they still call it a collection fee, but I like to call it a cure fee, which is the legal definition of fixing a default. You're curing it. So we'll call it rescuing. You could also call it a get out of default penalty. If you rehabilitate, it's 16%. If you consolidate, it's 18.5%. So the small advantage of rehabilitating is you save 2.5%. I honestly don't know that that's worth it, because rehabilitation can take 10 months. Consolidation, you could be done in 60 days. And to me, I'd rather you be out of default now and spend those extra 6 months paying it. And I think that, to me, is a better credit fix than rehabilitation. The credit fix you get with rehabilitation is they take the word default off your credit. The 90, 120s, and 150 late payments, that stays. Under rehabilitation law, that's allowed to stay. But with consolidation, you're out quicker. And so part of the question of rehabilitation versus consolidation is, do you have a sense of urgency? Do you need to be out now, or can you wait? Does it make sense? Also, with rehabilitation, you've got to make payments. With consolidation, you don't pay until you're out of default. So that can also keep some money in your pocket. Also, look at your income. You can't apply for an income-driven repayment plan until you're fully out of default. If you, especially right now, are suffering an income issue that could be fixed by January or February when your rehabilitation is done, you might want to get into IDR now at a lower amount versus waiting until January when you're fully employed and making your full potential, and now your IDR is substantially higher. So you have to balance what makes sense. The 2.5% to me is a red herring. especially for those of you on income-driven repayment who will never pay off the balance of your loan anyway. And let's be honest here. My clients are averaging $75,000 or more in student loan balance, and quite often it's six digits. If you owe $100,000, and this is an extreme example, but if you owe $100,000 and you're a family of five with an income of say $40,000 a year, your payment on IDR is really small. I'm saying under $100 a month. Even at $100 a month, you're never going to pay off $100,000 with interest. So do I care about the extra 2.5%? No. I care about getting my client out of default now as soon as possible, getting them on that 25-year forgiveness clock now as soon as possible, and also the mental weight of knowing that they're out of default, their credit is healed, and they can go on. I literally take this huge mass of a student loan stressor and we crush it down. We make it a little pebble. You put it in your pocket. Does it still annoy you? Yeah, from time to time it does. It's still there. You still have to make payments. But it's not this huge weight. But then again, I do have some people where credit is king and they've got to get that word default off, so they'll do a rehab. Remember, federal student loans have to comply with the Fair Credit Reporting Act. So outside of a Perkins loan, your Staffords, your Plus loans, they still fall off your credit report in 7.5 years from default. So if it's been 5 years and now you have a choice of consolidate or rehabilitate, that word default is only coming off of your credit report for 2.5 years. And actually, it's going to be only 2 years by the time you get out of default. So is it worth all those extra payments just to make your credit look a little bit better for 2 years? After 7.5 years, the whole thing is off. The fact that you consolidated or rehabilitated has no bearing. There are other things to look at, and I don't want to go overboard on credit reporting, but that's really the rehabilitation. Cassandra, thank you for that question. I went way overboard, but there is, first of all, the servicer was wrong. Now, something for you, Cassandra, if that servicer was actually a debt collector and they said this, there might be a Fair Debt Collection Practices Act violation there. And I'd encourage you to talk to an attorney, whether it's me or somebody else, just to find out. Because one of the reasons for Fair Debt Collection Practices Act lawsuits, I see them as public service lawsuits. If a debt collector is doing it to me, then they're doing it to others. And until they get slapped, they continue doing it. It's just the cost of business for them. So, I'm not anxious to have people sue, but it might be worth looking into. Now, what I will say, just to fully qualify this issue, back in the Obama administration, they stopped charging the 16% rehabilitation fee on direct loans. I don't know if they're still doing that. I had heard back almost 2 years ago that Betsy DeVos wanted to get rid of that 16%, but I don't know if they're still doing it, so I can't promise it. So if the debt collector is saying on a direct loan that rehabilitation has no fee, they might be right, and you're not going to know until you fully rehabilitate. And I got to tell you, if you do rehabilitate and they do smack you with the 16%, that's a fun lawsuit. I'd like that one. But again, this isn't legal advice. This is a Facebook discussion. I'd encourage you to talk to an attorney and look at the details. Also remember, as a client, you have the right to walk away from a lawsuit. If you don't want to do it, you don't have to do it. I've had quite a few people that had class action. They said they're not interested, and I'm okay with it. My goal as a student loan attorney is to make sure your student loans are handled. Debt collectors, if you want to go after them, we can talk about that. Thank you, Cassandra. I'm glad you like the credit stuff. I may do some more talk about that. But it's been 30 minutes. Do we have any other questions about what we've talked about, which has been everything? I think it's important, again, no matter what kind of loan you have, if you have any questions about it, contact your servicer. Your direct loans are covered. FFEL loans are not, so call your servicer, see what you can do. Private loans are not protected. Call your servicer, call your lender, see what you can do. And look at your state government website and see what they're offering and compare and contrast the two. If your governor has come down with some kind of edict and your private lender doesn't want to comply with it, I'd contact your attorney general's office, because there may be some enforceable issues there that they want to deal with. You may also want to talk to a private consumer attorney and see if they're interested. You can find private consumer attorneys at consumeradvocates.org, which is NACA, National Association of Consumer Advocates. If you want to talk bankruptcy, you can find those at National Association of Consumer Bankruptcy Attorneys. That's NACBA.org. I'm a member of both. I don't get a referral fee for saying any of this. I just want to make sure that you guys are getting help. And of course, if you have any issues, please feel free to reach out to me directly through my website, www.thestudentloanlawyer.com. You can email me directly, jcohen@thestudentloanlawyer.com. And I'm going to continue doing these every week. You can see the past ones on my Facebook and on my website. And please feel free to spread the news to other folks, and let's just keep helping people, and we'll go from there. Thank you all for joining me, and I hope you all have a good week. Stay safe.